Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome, ladies and gentlemen. I'm Hiral Dadia. Welcome to Nirmal. We have Jonathan Barratt, CIO at Probis Financial Services, joining in. Welcome to the show, Jonathan. It's a pleasure to speak to you as well after such a long time. The first question coming to you over here is, all of us have already seen as to what's been the impact of COVID, at least on majority of the economies. In fact, no one has been spared right now. And this is the time where everyone is actually talking of a revival plan, of a recovery coming in with regards to economies. However, an interesting fact is the capital markets have been on an uptrend over the last couple of months. How would you see this entire phenomenon panning out from here on?
Yes, good afternoon. Look, I think it's going to be quite interesting because as we've seen the Dow Jones and all the equity markets having these tremendous rallies, we've got to actually understand why they're actually rallying. Is it because of this optimism? Is it because we've got such very cheap money or a very low monetary base? And I think that it's fair to say that the recoveries that we anticipate and what people do anticipate are on the back of that weaker monetary policy. So how long will this last, I think, is a question. For those lucky people that got in when the Dow did fall down or when the equity markets are on their knees, that's good, but will it last? And I think in my mind, I think that as soon as we get a hint that, we do have that the virus under control, we do have that second wave under control, then I think you'll find that monetary policy will start to tighten up. And if that's the case, then I think you will see that correction start to unfold. When we look, we're at a double top. If interest rates start to move up at all, then I think that'll be a sign for investors to get out of the market, and then we should see that correction, which, mind you, still wouldn't be a pretty bad area to start to buy again.
Absolutely. And with this as well, what's happening as well, everyone was talking of a recession. There are people talking that yes, very soon we could see markets crashing in. Do you see that happening, or are you expecting this kind of upside to continue and the worst is behind us?
Excuse me. I think that the worst is behind us. I think that when we look at what's actually happened to the economies, we were expecting recessions and depressions. We have seen such technical recessions unfold, yet the market still wants to be quite bold and sort of take it higher. So I get a sense that the correction will be, but it won't be as bad as what people expect. I think that the recessions that we're having, where they're not as bad as what people expected, when we saw unemployment in the States, when we saw where that went and now it's improving, people are starting to say, well, look, parts of the economy have shut down, and that has been a concern, but other parts are quite vibrant. So when we take that all in one mass, how bad should this actually be? And I think it shouldn't be that bad. And I think because we've seen those markets recover, that anything that we do see this correction, will see a correction. It will come, but the chances are that it won't last. And I think that's the point. The point is that if you see this big buy, it's a buy on dip because the economies will recover. That infrastructure trades, which everyone's starting to put on, they're not going to turn off overnight. And if you do think a lot of governments have massive infrastructure deals put on the table, and they're going to continue. And with that, I think that will certainly arrest a lot of the clients that we're expected.
Right. And overall, if you go to see, right now, the kind of liquidity infusion that we're seeing, at least across the globe, especially in terms of Europe and US, I mean, probably that's something which is actually driving the liquidity in the markets as well. However, if you see in terms of Indian markets, we don't have that quantum of money that's being printed. In fact, it's almost next to nil. Now, probably, yes, we are mirroring what's happening in terms of global markets. However, do you think this could be a bubble right now, Jonathan?
I think in certain areas, there a lot of people have looked at this liquidity bubble, that we're living in, and when all of a sudden that liquidity dries up, what does that actually mean? I mean, those economies that have those big, massive projects there that haven't just sort of printed money as much as possible, they're the economies that the ones will survive. Those that aren't, and you look at how much the US is printing, how much Europe is printing, you get this sense that they're just going hell for leather on it. And as a result of that, that bubble will burst. I think the Asian economies have done things slightly different. And I think when I look at India, when I look at China, I get a sense when I look at the amount of money they've printed, it's not a hand over fist in terms of it. So I think if anything there, we'll be looking for sort of more stability in those Asian markets as opposed to those European markets, which if there is that crisis, they're the ones that are going to hurt. Remember, they did go through another financial crisis, the debt crisis in Europe. So as a result, they've had to do that. So that's why there is that little bit of difference between the two areas of economies, which might come under correction.
Right. And overall, right now, a lot of people got onto the boat, when markets crashed in the month of March and have, got the fruits of it right now. There are people, Jonathan, who've missed the boat. What would your advice be to investors right now who are looking to get into equity markets?
Yeah, look, that's going to be a very, very tough question. Look, if you've missed that boat, it's very hard to say. But if I were going to, and I needed to and wanted to invest in the equity market, if I were going to invest a dollar in, I'd probably only put 10 cents to 15 cents at this time. I'd sort of wait. I'd sort of hold off and say, well, we don't know whether it's just going to keep on going. We don't know how long this liquidity is going to be with us. So let's try and take advantage of us. But I wouldn't actually be putting a lot of money into it. In fact, I'd still be waiting. I think if anything there, as I mentioned, if you're going to spend a dollar, I think 10 to 15 cents is fair because you need to be involved in the market, or if you're not, and then wait for better opportunities. And as we see that correction come, you're buying into weakness. And I think that's probably the suggested play.
Right. And overall, right now, if you go to see, everyone's talking of that probably markets will keep swinging between fear and hope. And this is probably until a medical solution emerges. Now, if that is supposed to be taken into consideration, how should an investor's probably 3 to 5 year blueprint look like broadly?
Well, I think when you look at that blueprint to investment, there is a lot of that money, and there's still a lot of infrastructure, a lot of development, which is occurring. I think when you look at the companies now that have weathered the storm through these areas, through this pandemic, they're the companies are the ones that are going well. When you look at the technology sector is going in leaps and bounds. So if you were to see which were the markets, the sectors of the market that were actually going to be the ones, the stalwarts, the ones that were going to richly the major companies that are going to benefit the most, it would have to be that technology sector. So if I were to look at that blueprint, what were the stocks and what were the areas, the sectors that I'd look at? And I'd still stick to, and I have been for a while, sort of the mining sector is good, and also the technology sector, and of course that healthcare sector as well. But generally speaking, mining and I think the technology sector is the one to go for.
Right. And overall right now, if you have to look at emerging markets as a whole, where would you actually place your bets?
Look, I think it's when you look at the emerging markets, I think it is tough because I think you've got to take more of a scattergun approach to it. When we look at the pandemic, when we look at second waves, when we look at some of those emerging economies, it is quite hard. If I look at some of the commodity markets, and I can see some of the movements which we've had there. When I look at copper, when I look at iron ore, massive amounts of movement. When I look at oil, have not been that good. But when you do look at some of these commodity markets, you get also a sense that the pandemic is playing out there. When you look at Brazil, we look at the mines. So would you be invested in that area? Would you? So I do think wherever you invest in, doesn't matter which regions you're investing, it really is the sector that you're going to invest in, which is the key, because it's those sectors which you have that leverage and which you should be able to profit on.
Right. And if you're talking about equities as well as other asset classes, I mean, usually, when equities are rallying, you have commodities which are slightly on the lower side of the curve. This time across asset classes, you're seeing a good up move coming in. It's only crude, which has been on a downtick right now. Which are the asset classes you would put your bets on?
Look, I think when I look at that, and that obviously we've been running with some positions for quite some time, and if I were to look forward, which are the commodities which I like, and I think when I look at the mining sector, when I look at some in particular, like copper, for instance, I still like copper. To me, is one thing which is an area which has an issue which would be hit. It also has a supply issue. So in my mind, I'll be leveraging to those stocks, that have that exposure to the copper market. We've always liked iron ore. Iron ore in my mind, iron ore and coal, they're the real grassroots of any recovery when it happens. But more importantly, they're the primary inputs which are required for these infrastructure projects. So if you're going to build a railway anywhere, obviously you need these types of inputs. And when the government's suspending these programs, they're not short-term programs, they're long-term programs. They're 5 to 10-year type. So when they start, they're not going to pull back. So when you look at those primary input markets, those base metals, I think are still very, very good in terms of exposure. Your zincs, your nickels, copper I really like because of supply issues. So I like the base metals. The precious metal markets, I still like. They've had a big run. A lot of people are starting to take profits at these levels, but I think at the end of the day, if you do see a pullback there, I still like it. If I'm looking at the oil market there, big concerns there about demand again. And I think with people actually staying at home and not traveling, then that demand's not going to be there. So once again, it's more of what's happening with the pandemic that'll help the oil market.
Right. But when you're talking of base metals, Jonathan, what's happening is currently the demand that's coming in is mainly coming in from China. And
Right.
do you think that's something which will actually support base metal prices? Or in turn, you have the US-China trade war that continues to flare up. I mean, the kind of volatility that we're seeing on that conversation is only intense. How do you see that these two factors actually impacting prices right now?
Look, I think the China argument and the China discussion is key. When we look at it, not just the base metal markets, when we also look at, say, iron ore, yes, we've got this trade war occurring, and there's no doubt about it, and it certainly helped, it certainly hurt a lot of other countries. But China needs these essential inputs. And they've been the buyers for this, not just for the last year, but for many, many years. The one belt, one road scenario is something that's going to last for quite some time. If you are refitting the infrastructure for a country that big and that size of the economy, then this demand is going to be with us. It'll ebb and flow naturally, but I think at the end of the day.
Right. And overall, Jonathan, if you see in terms of what happened in the month of, say, June, July as well, you saw iron ore prices which already topped almost $100. Now, currently, if you go to see, do you think there is a possibility of the repeat happening in terms of a compression in steel spreads is concerned going forward?
Oh, look, I think that's always, yes, absolutely. That can always occur. But I think we've got to look at the trend. We've got to look at the trend, and we want to look at within the sort of the peaks and the rivers and the hills and all that and the valleys. There is this underlying trend. And yes, that compression will occur. It always converts. It will always. When we look at the commodity markets, the base metal markets, it's the same thing. We look at the supply, we look at what's going to restrict the supply, and we're going to look at the demand. And, when we look at that, we can see with the iron ore market, with steel production, China is the largest steel producer. What's going to hold them back? And I think that's the key. What is that demand and who is demanding it? Yes, they're sort of producing. Yes, they're also selling as well. So when you look at it, that demand for the commodity is there. And whilst it's there, not just for the domestic use, but also the international use, you can see that these commodities will remain relatively stable on a dip, but if they move, they will continue to move higher.
Right. And then with this, if you talk about gold as well as silver, gold was the one which actually started rallying earlier, and silver has now started to catch up. However, if you go to see, it does not seem to be a good fundamental demand that we are seeing in terms of gold and silver. It's more of on the trading side. Are you expecting that there could be probably a stronger underlying demand that could come in for gold and silver, which could fuel up prices further from here on. Or, because equity markets, still people really don't have the confidence.
Mm. Look, I think that if we're looking at another correction, if we're looking at the reasons why monetary policy will tighten, I mean that has to come down to some form of a lot of money in the system. Dare I say that inflationary word? If we like to think it's not there, but if it does start to come through, then you'll start to see people moving back to gold. It's had a great move, there's no doubt about it. But I think it's going to go through this consolidation phase. So I do think there's a definite pull towards the metal once the right levers are applied to it. One of those things is, well, look at the US dollar. Look how that's trading at the moment. It's sort of at a level, where we think that it'll start to move higher. That's not going to bode too well with gold. When we look at the dollar index, that's around about that 93 level. And if that 93 can go just down to that 92, but overall we feel the dollar index will firm. So that's not going to help gold. So really the levers at the moment for gold are not that inviting, although it still can trade to the top side a little bit more. But when you look at the silver market, more of an industrial use, you can say, yes, I think there is more sense in that. There's more sense in that. When you look at where gold has reached and you look at silver, there's more of a silver play going on. But that's not the right time to buy it now when you look at the gold-silver ratio, because that's favouring gold again. So, but when I look at it, the opportunities in the precious metal markets are certainly there. It is a question of timing and the right time to get involved back into that market.
Right. So if we look at probably some bit of correction that could come in, because valuations have been steep right now in terms of equity markets. One such event that we have been watching out for right now, at least on a global level, is US elections. Do you think that could be a factor which could cause a correction in terms of global markets, which in turn could impact, probably emerging markets like India as well? And that's the time when probably you would see movement happening from equity markets to bullion.
Absolutely. I mean, it's a bit of well, let's see what happens with the election. I don't like both candidates that are in at the moment, I must admit. Mr. Trump's doing his best and Sleepy Joe's doing his best as well. Look, I think at the end of the day, I think what the market's looking for is stability. Stability in the US government. If we do get someone that is just consolidated, we get a Joe Biden and we get that consolidation, I think that's going to be positive and will bode well. Are we looking forward to another series of Donald Trump? I think that's going to be hard. However, we've seen him before. So we know what to expect and we know what to discount. So the shocks aren't going to be as much. So I guess when I look at the overall, whoever gets in, I think will create that stability for the market. We'll have people that Joe Biden's won't be all that aggressive. We know the Donald Trump camp and what they're on about. So I think if anything, that'll provide us with that little bit of stability. We've seen so many shocks in the last administration, but we seem to have got through them all, and we seem to be going all right. So I think as a result of that, when we look at the election, I think it's going to be close, but at the end of the day, I don't think it's going to make that much of a difference to where we are positioned in terms of that overall global economic growth.
Right. So if you have to look at gold and silver, what are the kind of probably targets that you are setting right now for both of these commodities?
I guess when I look at gold, we know that 2000 is important. 2010, we know those areas are very important. At 1900, if it gets below that 1900, back to 1870, you've really got to have a look at it to buy. I actually feel it is at the lower end of its range at the moment. I still think there are still too many things out there in the market which are actually saying, well, look, we've got issues. So if I were to telegraph the issues, we know what they're going to be like. The US perhaps under pressure. We're going to see people exiting markets, so that'll be a weaker dollar. If they feel that the equity markets are too high, we feel that there's a bit of inflationary. So I think that dip to gold is looking quite better bid for me. And I think if you do get around that 1900, I think it's quite positive. I'm always been long gold, as a lot of people know, and I've been enjoying that ride. I think it's still going to continue.
Right. So what are the levels that you're tracking with regards to where the dollar index goes as well? Because overall, if you go to see the pressure has continued, I mean, do you think a possibility of me going down to 80 to 85 levels?
What, on the dollar index?
Yes.
Yeah. I mean, look, I think not quite yet, but I do think it's there. It's there to be had. We're steadying off at the moment. That 90 area, I think, is quite critical. One interesting point about it is that, and not a lot of commentators are actually looking at this, you know, with the dollar index, you play to the US economy will play to its strengths. And a lot of the economy has been internalized to an extent that they want to promote the local side. They want to promote the local economy. The only way they're going to do that is to allow exports to continue to rally. So when I look at that, I think that there is a theme to allow the US dollar to weaken over time. Now, it won't happen overnight, but it has been happening. So I think if anything, we get this rally in the dollar, you know, on some good news, good feel story, whatever, it doesn't matter. But I think the trend is there for it to weaken. And if the trend is there for weaken, then yes, 85 is certainly something there, and maybe even lower. We have seen it lower. There was that policy that we had was all about dollar weakness that I don't think a lot of traders can remember. But that policy about dollar weakness was all about trying to get that domestic economy going through their exports. And I think we'll see a revival of that over time.
Right. And overall, if you go to see again with what's happening with crude, I mean, clearly you have Saudi Arabia as well, which has come out and reduced prices right now with regards to crude sending to India or a few of the other countries as well. And that's clearly giving us an indication that probably they themselves, who are one of the biggest producers, are expecting a decline in demand to continue. If that is something that we pick up, what are the levels that we should be tracking in terms of crude? Do you think $30 to $35 is going to be the next $100 right now?
Well, look, I think you're dead right. I mean, one of the interesting things is that the economies, we're in a new economy. We're in a new, we've done a leap in transformation of how economies play out these days. And I think with that adjustment, we're going to be seeing that with our primary inputs such as oil. And, you know, when you look at how much oil we have and how much oil is coming on tap, you have to question whether or not you'll ever see those days of $50 a barrel again or $55. And I think a lot of the chances of that, whilst we're in this new economy, we won't see that. So I get a sense that the ranges we're seeing, you know, 40 on the top side, 45 on the top side, is probably it for the time being, 35 on the downside. And I think it'd be leaning more towards the downside. Because remember also, if the price of oil is weak, but the price can pass well profitably for other exporting countries or producing countries, and it helps the other economies, like those dependent economies such as India and Japan, if it helps them as well, then that's going to help the whole global economy. So I think that this new economy that we're living through will create prices and cheaper energy prices. And as a result of that, I think oil will tend to be softer rather than stronger.
Right. And lastly, let's just talk about, you know, what's your view in terms of where the Indian markets are concerned? What would your view be? Because what's happening is, firstly, you have the entire work from home culture, which is coming in right now. If that continues, who do you think are going to be the key beneficiaries, number one? And number two, India is moving, you know, towards go local, buy local. So they want to become self-sufficient in a lot of things. If these two are the things that we are looking at, do you think there is a possibility that India, if not replace, but supplement China to become a manufacturing hub versus, I mean, we've always been known as a back office hub.
Well, I think when you look at that back office area and you also look at that manufacturing, I think what we're seeing is this internalization occurring. You know, people are revisiting their values within their borders. And they're saying, well, let's supply, let's buy local, let's travel local, let's do more business local. You know, let's look at it. How can we do it? Manufacturing. You know, when we look at how China surged ahead, India will take parts of China, you know, in terms of, you know, some of the philosophies in terms of manufacturing. You know, but I think the manufacturing will be perhaps a little bit smarter. it won't be more, it will be labour intensive, but it'll be a little bit smarter in terms of the technology. Because when you look at India, yes, it's a back office, but you also look at the technology, and then a lot of the technology that comes out of India as well, always very positive. So when I look at the size of the economy, I can see good things coming out of India, in terms of the tech side, in terms of the internalisation, more on the back office work, more on the tech side, the IT side. But generally, I feel that there is that element of manufacturing which should also come into the spin due to the fact that they've got that labour, which a lot of other countries don't have.
Right. So would you advise anyone to bet on India right now at current levels, or should someone wait?
Oh, look, I think like anything, and I'm an advocate of if you do want to not bet, but if you want to invest, in an economy, you start small and you slowly build. You get to understand the sectors of that economy. You know the good points and where are the growth points. And then again, you look at those stocks which will offer that. And once you find that, then you slowly. So you've really got to look at that top-down approach. You can say, which are the better economies? I mean, ask me a question. Would I be investing in the US at the moment? Probably not. Probably look to take profit. Where would I be moving? I'll be moving to those economies which I know, and of course India is one of those, economies which I know, if they internalise things correctly, they'll do well, and certain sectors will always do well. So when I look at it, I look at the Australian economy as well. That's another sector, another economy which I like. So there are these little pockets, of economies which will do well, and I think India is one of them, which will benefit from this pandemic eventually, as long as we don't get into another hit.
Absolutely. I mean, that's something that all of us are waiting as
Yeah.
well, because, India, interestingly, what's happening is it's rural India which is seeing recovery, and that's something which is actually supporting right now. Whereas if you see the urban economy right now, that's completely on a standstill. There is no growth happening on that front.
Mm.
And 60% of the economy is actually dependent on rural India. So if that growth continues, it's going to be a mind-boggling growth story that we could envisage from here on, provided all of us, grab these opportunities that are coming our way right now. But thank you, Jonathan, so much for joining us on the show. It was a pleasure to speak to you. Great insights that we've picked up. Speak to you soon and stay safe.
Okay, same to you. Bye-bye.
Thank you. Bye-bye.